Most people treat their credit score like a mysterious black box. This assumption is incorrect. Banks use this number to assess risk based on specific data. I used to think paying on time was enough to maintain a high score. Then I reviewed my actual report within the United States system. I found 5 specific actions lowering my number monthly. None of them were obvious errors at the time. Let us examine all 5. Before we start, I am not a financial advisor. I am simply a consumer who navigated this system using public data. Mistake number 1 involves paying only the minimum payment. I did this for years, assuming I was compliant. Your credit score weighs something called credit utilization ratio. This measures how much of your available credit you use at once. The general rule suggests staying below 30% of your limit. If your card has a limit of $1,000, keep the balance under $300. When you pay only the minimum, the balance remains high. Banks report your balance to the credit bureaus once per month. Whatever they see on that specific day affects your score. A high balance relative to your limit reduces your points even if you pay on time. The solution is to pay more than the minimum when possible. You can also make a second payment before the statement closes. Mistake number 2 is closing a credit card you do not use. This feels logical but removes available credit from your total. This action instantly raises your utilization percentage on remaining cards. It can also shorten your average account age over time. Credit scoring models prefer a long history of responsible usage. An old card acts as an asset by increasing your total available credit. You do not need to use it to keep it open. If it has an annual fee, contact the bank to downgrade it to a no-fee version. Sometimes closing the card is necessary if the cost outweighs the benefit. Mistake number 3 involves applying for multiple cards quickly. I tried to optimize rewards by getting 3 cards in 6 weeks. Every application triggers a hard inquiry on your report. One hard inquiry usually drops your score by 5 to 10 points. Several inquiries stacked together signal high risk to scoring models. The practical move is to space out your applications by 6 months. Note that rate shopping for mortgages or auto loans often counts as a single inquiry. Mistake number 4 is maxing out a card even if you pay it off monthly. You might not carry a balance, but the timing matters. The bank reports your balance on the statement closing date. This date usually occurs before your payment due date. If you charge $2,000 on a $2,000 limit, the bureaus see 100% utilization. This snapshot can lower your score temporarily. Make a partial payment before the statement closes to avoid this. You can ask your bank to increase your credit limit to lower utilization. Be aware that requesting a limit increase may trigger a hard inquiry. Mistake number 5 is missing a small payment due to forgetfulness. This happened to me with a $12 recurring charge on an old card. One missed payment appears on your report after 30 days. It remains on your report for 7 years. A single missed payment can drop your score by 60 to 110 points. The impact fades over time, even if the record remains. The fix is to review every card you own once or twice a year. Check for active charges, even on cards you never use. Set up autopay for at least the minimum on all of them. You can always pay more manually later. Autopay acts as insurance against forgotten subscriptions. They are small actions that compound in the background. The credit score system is an algorithm assessing risk patterns. It does not punish you personally, but it responds to specific inputs. Once you know the inputs, you can stop sending the wrong signals. This is not a secret to unlock, but a process to manage.